Imagine being able to spot the next Apple or Google before they blew up, before everyone else.
Yeah.
Talk about an investing superpower, right?
Yeah, that'd be incredible.
So today we're going to dive into the world of value investing to see if we can kind of unlock that ability at least a little bit.
Right.
And we are working with excerpts from the audiobook of Value Investing, From Graham to Buffett and Beyond by Bruce Greenwald.
Oh, great book.
Yeah, and what I think is so fascinating about this is that it's not even just about picking stocks.
Right.
Like, this deep dive can help anyone listening understand how companies are really valued in today's world.
Absolutely.
Which is useful, whether you are, actively investing or just trying to wrap your head around the business world in general.
Yeah, you know what I was even thinking?
Yeah.
These insights could even help you build a moat for your own career,
Oh, interesting.
making yourself more valuable in the marketplace.
Oh, that's a cool thought.
Yeah.
Okay, so Greenwald starts by kind of painting this picture of how the economic landscape has shifted.
Right.
He talks about this idea of franchise businesses, companies whose value isn't tied to physical stuff, but to their brand power or customer loyalty or unique technology.
Yeah, they're intangible assets.
Exactly.
Good.
He uses Coca-Cola as an example.
Right.
What's a bottle of Coke worth, without the brand?
Probably pennies.
Right, like if you just had the physical bottle.
Right, just sugar water.
Yeah, basically it's just sugar water.
Uh-huh.
But with the brand, it's a global icon.
Global icon, yeah.
And so this shift from tangible assets to intangible value is a huge deal for understanding how companies are valued today.
Yeah, I mean, think about how the old school value investors used to do it, right? They
Yeah.
would hunt for these cigar butt businesses,
Yeah.
companies with a little bit of value left to squeeze out.
Yeah, a couple puffs left.
Yeah, and in a world of franchise businesses, right, that approach needs a serious upgrade. Now it's about finding undervalued companies, but ones that have the potential for long-term growth driven by those intangible assets.
So that's the big question, right?
Yeah.
How do we find these hidden gems?
Uh-huh.
How do we know if a company's growth is the real deal or just hype?
Right. Well, Greenwald lays out this three-step process for us
Oh, cool.
to kind of figure out a company's true worth.
Okay,
He calls them the 3 pillars of valuation.
3 pillars.
Yeah.
Okay, I like it.
The first pillar is asset value.
Okay.
So what are the company's assets really worth if you had to reproduce them today?
So we're not just taking the numbers on the balance sheet at face value.
Oh.
We're thinking about, what would it cost to build a similar factory today?
Right.
Not what the company paid for it decades ago.
You have to adjust for reality, not just accounting rules.
Okay.
The second pillar is earnings power value.
Right.
And this is where we need to get realistic about a company's earnings.
Okay.
Forget about all the fancy future projections for a second. What are their current earnings?
Yeah.
And what's a sustainable level they can keep generating year after year?
So we're not getting swept up in the hype of, some hot new product.
Right.
We're looking at their consistent earning power
Right.
to see if their growth is actually sustainable.
Uh-huh.
I think that's a really important point for anyone listening, who gets caught up in the latest trends.
Absolutely. I mean, remember those dot-com companies?
Oh, yeah.
I mean, so many had these sky-high valuations,
Yeah.
based on projected growth,
Totally.
but the earnings just weren't there to back it up.
Yeah, that's a good point.
Yeah.
Okay, so we got asset value, we've got earnings power value.
Uh-huh.
What's that third pillar?
The third pillar is where things get really interesting.
Okay.
It's the value of growth.
Okay.
Greenwald digs into this question of when growth actually ADS value.
Okay.
And his argument, and this is what I find fascinating,
Yeah.
is that growth is only valuable if it's happening in a protected market.
A protected market. So not every type of growth is created equal.
Right. Think of it like this. You could have 2 companies growing at the same rate, but one is growing in a market where they have a strong competitive advantage,
Okay.
what Greenwald calls a moat,
Mm-hmm.
and the other one is in a market where anyone can jump in and compete.
Oh, I see.
Yeah.
I'm starting to see where this is going.
Yeah.
So a company with a wide moat can grow and keep those profits,
Right.
while a company without a moat is constantly fighting off competitors.
That's it, exactly. And this is key to understanding why companies like Amazon are so valuable.
Yeah.
Their growth isn't random.
Yeah.
It's happening in areas where they have a strong competitive advantage.
Okay, I am definitely intrigued by this moat concept.
Yeah.
So tell me more about these moats and how they actually protect a company's growth.
Okay.
What are we looking for here?
Well, there are a few different types of moats.
Okay.
One is customer captivity.
Okay.
Think about companies like Microsoft. Switching to a new operating system or software suite
Oh, yeah.
can be a real pain.
Yeah, total pain.
Or think about your phone.
Oh, yeah.
Once you're in that Apple or Android ecosystem,
Right.
it's hard to switch.
It's so hard.
The stickier the customer, the wider the moat.
So it's about making it difficult or costly
Yeah.
for customers to switch to a competitor.
Right.
Okay, that makes a lot of sense.
Yeah.
What are some other types of moats?
Another type is proprietary technology.
Okay.
So think patents or trade secrets,
Uh-huh.
like the famous Coca-Cola formula.
Right.
This gives a company a unique edge that's really hard to replicate.
Makes sense.
And finally, there are economies of scale.
Oh, yeah.
Sometimes bigger IS, better.
Okay.
Being the biggest player can give you cost advantages
Okay.
that competitors just can't match.
So if you're producing something at massive scale,
Right.
you can do it more cheaply than a smaller competitor.
Yeah, much more cheaply.
That's a powerful advantage.
It is.
But I gotta ask, are these moats impenetrable?
That's a great question.
Can they ever be breached?
And that's where we need to start thinking critically about how to apply these concepts in the real world.
Right.
Not all moats are created equal.
Yeah.
And even the strongest moat can be weakened over time.
Right.
That's why we really need to understand the different types of moats and how they function in different industries.
Okay.
But we can dive into those nuances in part 2 of our deep dive.
Yeah, this is already making me rethink how I look at companies.
I think so.
It's not just about their current size or even their current growth.
Right.
It's about understanding the source of that growth and whether it's sustainable.
Exactly.
I'd love to hear more, though, before we move on, about how Greenwald suggests we actually identify these moats in real-world companies.
He gives us a really interesting framework for that.
Okay.
And I think it'll be particularly helpful for you, the listener, as you start to analyze companies yourself.
Cool.
But let's save that
for
part 2, where we can really delve into the nitty-gritty of moat analysis.
All right. I'm already hooked.
I think you'll like it.
Okay, we are back and ready to dig even deeper into these moats, these competitive advantages that can really make or break a company's long-term success.
Right.
I have to admit, I'm finding this concept super helpful.
Yeah.
Like, it's really making me rethink how I look at different businesses.
Yeah, it's a powerful lens for analyzing businesses.
Yeah.
And Greenwald does a really good job of breaking down how these moats actually function in the real world.
Okay, so let's get into, like, the nitty-gritty then.
Okay.
Of actually identifying these moats.
All right.
So remember those 3 pillars of valuation we talked about?
Yes.
Asset value, earnings, power value, and the value of growth? Well, they play a crucial role here, too.
They do.
So we're bringing all those pieces back in.
Exactly. When we're trying to assess a company's moat, we need to look at each of those pillars through this lens of competitive advantage.
Okay.
So, for example, with asset value, it's not just about what the assets are worth, but whether those assets actually contribute to the company's moat.
So if a company owns a bunch of factories, but those factories are easily replicated by competitors, that's not really a moat.
That's not a moat, exactly. The asset needs to be something unique, something that gives the company an edge.
Okay.
Think of a company like Disney.
Okay.
Their asset value includes not just their theme parks and studios, but their vast library of intellectual property, like those iconic characters and stories that are almost impossible to replicate. That's a true asset-based moat.
That's such a good example.
Yeah.
So it's not just about the physical stuff. It's about the intangible value that comes with it.
Right.
I got it. And so how does this apply to earnings power value then?
Well, when we're analyzing earnings power, we need to ask ourselves whether those earnings are protected by a moat. Okay.
So if a company's generating high profits, but it's in an industry with low barriers to entry, competitors can easily come in and erode those profits.
So a company might be profitable today, but if they don't have a moat, those profits could vanish pretty quickly.
As competition heats up, exactly.
Okay. Think about like the restaurant industry.
Yeah, good example.
You might have a super popular restaurant with great earnings, but anyone can open up a similar restaurant right next door.
And then what?
Your competitive advantage is pretty weak in that case.
Yeah, exactly.
It makes a lot of sense. So it's not just about how much a company is earning. It's about understanding how sustainable those earnings really are.
That's it.
And I imagine this all ties into the value of growth as well.
It does, absolutely. Growth is only valuable if it's happening within a protected market,
Okay.
a market where the company has that durable competitive advantage.
Right. So otherwise that growth might just be temporary.
It might be fleeting
Yeah.
and disappear as competitors catch up.
Exactly.
Okay, so we're looking for companies that are growing in areas where they have a clear moat.
Right.
Got it. And earlier we touched on those different types of moats, like customer captivity and proprietary technology and economies of scale.
Uh-huh.
Can you give us some more like real-world examples
Yeah.
of how these moats play out?
Yeah, let's take customer captivity.
Oh.
Think of a company like Salesforce.
Okay.
The leading customer relationship management platform.
CRM?
Yeah, CRM, exactly. Once a business has integrated Salesforce into their operations,
No.
switching to a competitor can be a logistical nightmare.
Oh, yeah.
So they've essentially captured their customers,
Right.
creating a powerful moat.
So the cost of switching, both in terms of time and money, just keeps those customers loyal?
Keep them sticky.
Oh, that's smart.
Yeah.
What about proprietary technology?
Well, a great example of that is a company like Intel.
Uh-huh.
We talked about them earlier. For years, they dominated the microprocessor market because of their advanced manufacturing process and their intellectual property.
Right.
It was so difficult for competitors to catch up,
Yeah.
giving Intel this significant technological moat.
And that moat allowed them to charge higher prices and rake in those profits.
Exactly. They were the undisputed leader in their field.
Right.
And that leadership was directly tied to their technological advantage.
Okay, that makes sense.
Now let's look at economies of scale.
Okay.
Think of a company like Amazon.
Right.
Their massive infrastructure and logistics network allows them to offer incredibly low prices and fast shipping, something that smaller competitors just can't match.
So their size basically becomes a weapon.
It does.
Allowing them to outmaneuver and outprice their rivals.
Right.
That's amazing. So that's how a moat can be built on sheer scale and efficiency.
Exactly.
But you did mention earlier that even the strongest moats can be weakened over time. So what are some of the things that can actually erode a company's moat?
That's a really important question.
Yeah.
Because it forces us to think dynamically about moats.
Okay.
They're not static. They can change and adapt.
Right.
One thing that can erode a moat is technological disruption.
Oh, yeah.
Some new technology can come along
Yeah.
and completely change the game, making an existing moat obsolete.
Like how smartphones and tablets disrupted the PC market.
Exactly.
Challenging Intel's dominance.
That's a perfect example.
Yeah.
Another factor is changing consumer preferences.
Oh, right.
What's popular today might not be popular tomorrow.
Yeah.
And a company that's built its moat on a particular trend might find itself vulnerable when that trend fades.
So a company that was once a leader might find itself struggling to stay relevant.
Precisely. And then there's always the risk of government regulation.
Oh, right.
New laws or regulations
Yeah.
can impact a company's competitive landscape,
Yeah.
potentially weakening their moat.
So even if a company's doing everything right,
Yeah.
these external factors can come into play
Right.
and really disrupt their advantage.
That's true.
Okay, so that adds a whole new layer of complexity to this whole analysis.
That's why it's so important to think critically about moats.
Okay.
They're not a guarantee of success.
Right.
They're a dynamic element of a company's competitive landscape that requires constant evaluation.
This has been so insightful.
Sure.
So we've talked about these different types of moats,
Uh-huh.
how to identify them.
Yeah.
What's the next step? How do we actually apply all this knowledge
Yeah.
to make, informed investment decisions?
That's where we need to bridge the gap between theory and practice.
Okay.
And I think Greenwald's book provides a really good framework for doing that.
Oh,
He
yeah.
uses this fascinating example, a company called WD-40.
W40, you mean like the stuff you use on squeaky doors?
Yeah.
What could that possibly teach us about value investing?
You might be surprised. Greenwald uses WD-40 to show how a company's value can change as its strategy changes.
Yeah.
So you see, back in the late 1990s, WD-40 was like this classic one-product company.
Right.
Known for that, iconic blue and yellow can.
Yeah, the little blue can.
Yeah, exactly.
Right.
Then they decided to branch out.
Yeah, I vaguely remember them, like, acquiring other brands and stuff.
Exactly. They bought 3-in-1 oil.
Right.
And they started going after growth in these new areas. And on the surface, it looked like a good move.
Yeah, like a classic growth spurt.
Right, a growth spurt. But Greenwald argues that this growth wasn't necessarily creating value.
Why not? I mean, weren't they expanding their reach, bringing in more revenue?
They were, but here's the thing.
Okay.
WD-40 didn't have a strong moat in those new markets.
Oh, no?
They were up against established players, and they were spending a ton of money to gain market share.
So they were growing, but it was costing them a lot.
Yeah.
They were falling into that growth trap we were talking about earlier.
Exactly. They were chasing growth for growth's sake.
Right.
Without thinking about whether they had a sustainable advantage.
Yeah.
In those new areas.
Okay, so it's a cautionary tale.
It is.
Reminding us that growth alone doesn't equal value.
Right. Growth has to be the right kind of growth.
Okay, this is really making me rethink, like, everything I thought I knew about business.
I know, it's powerful stuff.
So how can we, like, as investors,
Right.
or even just people trying to understand the business world,
Right.
how can we avoid falling into these growth traps?
It all comes back to those moats.
Okay.
We need to be critical thinkers,
Right.
looking beyond the hype, asking the tough questions.
Yeah.
Is this company's growth happening in a protected market?
Right.
Do they have a moat that will let them keep making money as they grow?
Uh-huh.
Or are they just chasing these fleeting trends?
Right. So we need to be smart about what kind of growth we're looking for.
Yeah.
It's not just about finding companies that are expanding.
Mm-hmm.
It's about finding companies that are expanding intelligently,
Right.
strategically,
Yes.
with a real understanding of their competitive landscape.
You got it. And this brings us back to one of the core ideas of value investing.
Okay.
Specialization.
Oh, interesting.
Greenwald says investors should focus on areas where they really understand the industry,
Okay.
the competition.
So, like, if I know a lot about the tech industry,
Right.
I might be better at spotting moats in tech than in, say, healthcare.
Exactly. It's about knowing what you know.
Right. Playing to your strengths.
Yeah, and focusing where you have an edge.
Okay, that makes sense.
You don't need to be an expert in everything,
Right.
but you do need to have a deep understanding of the areas you're investing in.
Right.
That's where you find the real opportunities,
Okay.
the hidden gems that other people miss.
This has been a mind-blowing deep dive.
Yeah.
I feel like I'm seeing the world with new eyes now.
Good. I'm glad.
What would you say is the biggest takeaway from all this?
I think Greenwald's book shows us that value investing is like this timeless principle.
Okay.
It's not about chasing fads or timing the market.
Uh-huh.
It's about really understanding what makes a company valuable.
Right. But the way we apply those principles needs to change.
Yeah.
Right? We can't just rely on those old formulas and metrics.
No, we got to adapt.
We have to adapt our thinking
To today's
to
world.
the realities of today's world. Exactly.
We have to think critically about those intangible assets, those moats
Right.
that drive a company's success in the long run.
And be really discerning about growth,
Yes,
recognizing that not all growth creates value.
absolutely.
So it's not just about finding cheap companies.
No,
It's about finding great businesses.
right.
Businesses with those durable advantages that can generate returns for years to come.
Exactly.
This deep dive has given me so much to think about.
I hope it's given you, the listener, some new perspective as well on how to analyze companies and understand the business world. Whether you're a seasoned investor or just starting out,
Yeah.
these principles can help you make smarter decisions.
So to everyone listening, go forth, find those moats, and invest wisely. Happy hunting.
Good luck out there.